On today's Hashi, I'm discussing mortgage market insights from Zelman Associates Alan Ratner, the August foreclosure report, the biggest home price increase in 4 months, that report as well. Today is Tuesday, September 17th, 2024. I am Byron Lazine, and the hot sheet starts now. Welcome into the hot sheet. A good mix today, as mentioned there at the top. We've got the mortgage breakdown from a Zelman and Associate, or Ivy Zelman Associate, that is. We've got foreclosure talk to bring all those doom and gloomers out from their mother's basements, as well as some home price reporting from Redfin. First, make sure that you get your tickets to BAM Mania. If you're getting value from everything that we do at BAM, if you're a constant here on the hot sheet, you will not want to miss BAM Mania. There's going to be some conversations that haven't been had at any conference or event in the real estate industry, not only this year, but ever. BAM Mania is at Circa Las Vegas on October 18th. October 17th is the VIP experience. VIP get both days, the 17th and the 18th. General admission gets you into the kickoff party on the 17th, as well as all of the full event on the 18th. BAM Mania Circa Las Vegas, practically a brand new venue. Do not miss it. BAMmania.com for the speaker lineup. And to secure your ticket, BAMX members, you get 25% off of your BAM Mania ticket. Hit the thumbs up and subscribe here to the channel if you're getting value out of what we do with the hot sheet each and every single day. And thank you for tuning in, for those of you tuning in live. All right, let's kick it off here at the top with this Ivy Zelman, Zelman and Associates, Alan Ratner, who is a managing director over at Zelman and Associates. Obviously, if you follow the hot sheet closely, you know how I feel about Ivy Zelman. She was one of like 3 that actually predicted correctly the mortgage crisis. She's not predicting a meltdown for all those doom and gloomers. We'll get to foreclosures here in a minute, but she's not predicting any type of real estate collapse or anything even close to that. But Alan Ratner from her team made the claim on CNBC here that the Fed meeting that we're about to see, the Fed cuts that we're about to see, all of that is already priced in to mortgages. We've mentioned that here on the hot sheet. It's probably priced in. You're not going to see that big of a move in the mortgage market. We don't expect it to be, although the shift is starting to happen where it might be a half a point cut. We'll talk about that. So co-hosts from CNBC discussed with Alan why a Fed cut, whether it's the 25 basis point or a 50 basis point, would not impact mortgage rates. Okay, so he doesn't believe that this Fed cut coming this week, the Fed meeting is set to kick off here today with a press conference tomorrow, Wednesday afternoon, would not impact mortgage rates. It also would not impact his forecast for mortgage rates, home pricing, or inventory. Okay, so the first question from co-anchor, why wouldn't an announced Fed cut have more oomph when it comes to lowering mortgage rates? Let's go to the clip from CNBC and see Alan's response to this first question from Carl Quintanilla.
So why wouldn't an announced Fed cut have even more oomph when it comes to lowering mortgage rates?
Well, as we've seen really since June, when mortgage rates peaked in the mid 7% range, the bond market's anticipating a Fed rate cut cycle. I know there's a lot of debate whether it's going to be 25 basis points or 50 basis points, and I don't have a view that's any better than anybody else at this point. But the mortgage market's already pricing in a Fed easing cycle. We've seen mortgage rates already pull back roughly 100 basis points from the highs. So the Fed simply announcing this week, however much they're going to cut, that shouldn't have too much of an impact, I would think, on the mortgage market. Over time, we do expect to see rates gradually decline as inflation hopefully remains tame. But in the near term, I wouldn't expect much movement.
Okay.
Do you think we can rely on a
We'll go to the follow-up question there in just a second. One thing that if I'm an agent, might be worth a try, might be worth the notice to your customers, to the people in your database, of sending out an email today. Hey, Fed meets today. The decision is not likely to change mortgage rates. So for buyers who are on the fence of thinking about this waiting game and doing what we talked about yesterday, articulating the opportunity that where inventory is highest level it's been since 2020. Mortgage rates are the lowest they've been since February 2nd, 2023. If the Fed's decision this week isn't going to change rates all that much, or it's unlikely to, what would we be waiting for? We have the momentum that we've been waiting for. It's already right there at our fingertips. Let's go take advantage of it. Let's go to the next question from Quintanilla.
5 handle for most of next year, and would that be some kind of solution to this lock-in effect we've seen?
Yeah, I think that's kind of what the forward rate curve is telling us, that we should kind of dip into the high fives at some point over the next year. And we do think that that will help to unlock some activity, especially in the resale market. Interestingly, in the new home market, where builders are already buying down mortgage rates to the fives, and even in some cases the fours, we're seeing pretty solid activity already.
That's
so what about this?
That's interesting because we've seen months of inventory grow more in the new home market than in the resale market. Okay. Months of inventory is much higher in new homes. Yet they're buying those down into the fives and even into the fours. Okay. So the higher price point that new homes averages out at, I think, is more of a stopper for the buyers that are out there right now. I know we've seen a big increase in appreciation on the luxury sales that have happened this year, but generally speaking, the pent-up demand, the lock-in effect, is really going to impact those resale price points where, whatever median price point is in your market, that's where you're going to have the biggest impact. We've looked at numbers and data where, such a large portion of the homes being sold are not happening at those higher price points. And a lot of the new construction, because of regulation and everything that builders, how expensive it is to build, those prices have to be higher than the median throughout most communities, not all. Okay, let's go to the next question here.
Supply issue. Clearly, that's why people say that the higher rates didn't have as much of an impact on the way up, and lower rates might not have an impact on the way down, because it's just messing up the whole affordability equation. Where are we on new supply, and when we can get closer to balance and closer to more affordable levels?
So supply is increasing. It's increasing in the resale market. It's increasing in the new home market. It's still at fairly modest levels overall. But what we're seeing is in the markets where resale inventory has risen the most off of the bottom. So think of markets in Florida, parts of Texas. What we're kind of seeing there is you're starting to see a little bit of improved activity on the sales side, but pricing power has really moderated. So pricing is more flattish, maybe even dipping a little bit lower. So that's kind of what we expect to see on a more national level as inventories rise, as you see some of this inventory getting unlocked as rates move down. We do think that activity and transaction volumes will improve, but we're expecting a pretty tepid environment from a pricing perspective because, as you mentioned, affordability is still the biggest burden right now.
Speaking of prices coming down.
So if you actually, what he's saying, if you actually want to sell, you can't go into a runaway environment with your prices, affordability still being that biggest burden. So that, I think, is the overall point. Like, to get that lock-in effect that they talked about earlier, to really loosen up, affordability has to improve. Now, yesterday we went over the Zillow report where you've got in 22 of 50 metros, according to Zillow, it's actually, more advantageous to have a mortgage payment than it is to have, go out there and get a monthly rent. And so if that dynamic keeps shifting and softening, you can see, more activity going into next spring. I still think this winter is the opportunity for buyers because sellers are going to feel a lack of demand if they're on the market, more so than they would feel that, say, in February, March, April of next year. The next 4 months, it's just going to feel different for sellers, which gives buyers a better opportunity to go and attack the market. Let's go to the final question here.
Down. I know you delve into various individual markets, but Austin, San Antonio, Dallas, right? All these Texas markets. What do you think is happening there regarding supply and demand? That, I mean, how much of the rest of the nation needs to be paying attention to that?
So, those are markets where resale inventory has begun to rise. And a lot of the increase, frankly, is just homes sitting on the market a little bit longer, as opposed to new listings accelerating at a very dramatic rate. But, I think every market is a little bit different. I was in Dallas about a month ago, and one thing we heard from a lot of builders there is that, the job growth has slowed there, and they feel like that's what's having more of an impact on activity. Whereas in Austin, maybe it's a function of more inventory rising from people that bought second homes or might have been working remotely during COVID that are now perhaps going back to the office. So, there's a little bit of a digestion period going on there. Texas is still a market that has very solid population growth. Builders are very bullish on the market longer term. But I think anytime you see a fairly rapid rise in inventory, even if it's coming off of low levels, there's more of a digestion period. And I think pricing is ultimately the lever.
I think his answer there is reflective of the reality in terms of we're not seeing a rapid increase in new listings, and we haven't, right? We just went over new listings yesterday. While they were up for the week versus, 2023 and 22 levels, there's no situation where we're back to, the 20 teens of what new listings look like when you compare these numbers to those. And so the inventory is more of a case of sitting on the market longer, starting to get back to normal days on market. And sellers need to come to grips with the fact that you shouldn't freak out over a week of, not having a sale. Buyers are taking a much slower approach. Could we get back to a faster moving market in the spring? It will depend on those rates. If a lot of those locked up homes can go out and feel like they've got enough opportunity to buy, that's where you'll see more fluidity and potentially a faster moving market. But the market is slowing back to a normal pace, not anything close to like a screeching halt or anything like that, obviously. Okay, U.S. foreclosure activity. Adams August 2024 U.S. foreclosure market report revealed a total of 30,227 foreclosure filings. Okay, 30,000. Is that a lot? Well, it's down 5.3% from the previous month and 11% from August 2023. Nevada, Florida, and Illinois had the highest foreclosure rates, and both foreclosure starts and REOs declined nationwide. Foreclosure starts, and actual REOs all declined nationwide. They're declining off of ridiculously low levels. This is something I think is really important. Make sure that the father of the buyer, the new first-time home buyer that you're working with, understands that. Oh, wait for the foreclosures. You could be waiting literally forever. We're nowhere even close to the foreclosure levels that we saw, even the bubbling up before the crisis. U.S. foreclosure activity declines both on the monthly and annually in August of 2024. This is a great headline. Obviously, you can use a hot sheet show notes to make this really easy on yourself. All of our BAMX members get access to these hot sheet show notes. You can copy and paste this information right into your communications with your database. This is a really important one for people to understand because for years they've been told, somebody on Twitter, somebody on the internet has said, wait, this market is about to blow up. There's going to be foreclosures. It's going to be a dip in real estate. And the data just doesn't support any of those claims. Those basement dwellers have been wrong year after year, and they just keep rolling out the same old story. This 5.3 decrease from July and 11% decrease from last year, August, is a significant move downward off of a near record low number to begin with. Foreclosure activity remains significantly lower than the 2008 financial crisis, where monthly filings exceeded 300,000. Okay, we're at 30,000. 30,000, by the way, is like a level of health. Some homes need to go into foreclosure. We should never be at zero. Okay, that's not the reality of how a market works. Shouldn't be at zero foreclosures. Now you shouldn't be at 300,000 plus either. But there is a healthy level. We seem to be at that right now. 1 in every 4,662 housing units nationwide had a foreclosure filing. Okay. Now, when you look at how that compares to the states with the highest foreclosure rates, going right into the hot sheet show notes, Nevada was 1 in every just under 2,500 housing units. Florida, 1 in every 2,600 housing units. Illinois, 1 in every 2,800. Okay, so those are the hot spots where you might want to look, if you're an investor working with an investor, those might be the opportunity spots where you're starting to see, almost double or double the other direction what the national trend is. South Carolina, 1 in every 28, almost 2,900. And then New Jersey comes in 5th, 1 in every 3,200. Here are the metropolitan foreclosure rates. Oh boy. Highest foreclosure rate cities: Lakeland, Florida; Chico, California; Columbia, South Carolina; Bakersfield, California; and Vegas are your top 5 for cities. The population, so with less than 1 million, you've got Riverside, or I'm sorry, greater than 1 million. So Riverside, California; Miami; Chicago; Orlando. Those are the highest. And so you see Florida on the list there twice. Florida's got, increasing inventory. And then the most foreclosure starts right now: Florida, California, Texas, New York, Illinois. These are also like the biggest states. So they're going to have the most foreclosure starts. Like if Rhode Island was on this list, I'd be like, oh boy, what's going on in Rhode Island? There's such a small state, I barely 1 million population versus, a place like Florida that's got 24 million population. Metro areas with the most foreclosure starts, again, big cities: New York, Chicago, Miami, LA, Houston. Houston is a massive city, 507 starts. LA, pretty big, 675 starts. New York, Manhattan, what do they got? 9 million people on the island. There's only 1,300 starts. Here's the completions. I mean, do you actually get to, because people have equity. Do you actually get to a place where the foreclosure is completed? Total completed foreclosures. Lenders repossessed just under 29 U.S. properties in August 2024 through completed foreclosures and REO. That's a 12% decrease again, and a 13.9% decrease from August 2023. So we were looking at the top line number before. Now this actual REO completions, 12% from the decrease from the previous month, and a 14% decrease year over year. States with the most REOs. So these are like, investors are looking for REOs on the MLS, or, where they can buy one of these REO properties. You only have 202 in Florida. You only have 224 in Illinois, 229 in California. Pennsylvania's leading the list there at 266. These are not big numbers. And what you're seeing, for those of you that are looking at REOs, you don't see a deal. People think, I'm going to buy a foreclosure, I'm going to get a deal. Right now, with where the market is and where inventory is, you don't see an amazing deal when you see those hit the market. They're like listed at market value. I mean, let me know in the chat if anybody's gotten a great deal on an REO this year, if they've seen a huge win for one of their clients or somebody else, or one of their investments on an REO off the MLS. I'd find that very rare to believe. Okay. All right. Let's go over to one of the reasons why is because numbers like this. Let's go over to the Redfin home price index. U.S. home prices grew 0.5% in August of 2024. Redfin is now saying that this number is the biggest increase in 4 months, according to their data. Remember, this is a little bit more of a look closer. I know it's rearview mirror still, but it's a little bit closer to the time that we're in right now, this Redfin data, as opposed to Case-Shiller, which is going to be a full couple months going backwards. So home prices, according to Redfin, grew 0.5% month over month in August, fastest pace since April. On a year-over-year basis, home prices rose 6.7%. That's the smallest annual increase since January. So that annual deceleration that we've been talking about, that continues to, even in this fresh data here from Redfin, continues to look like the case. 20 of the 50 most populous U.S. metros recorded a drop in home prices month over month. So something to watch for there locally. There's your month over month chart on Redfin, month over month versus year over year. So you see the deceleration on the blue line happening on year over year pricing, while month over month is seeing the biggest pop again since April. But you do have some metropolitan areas that are actually seeing a decrease month over month. Austin, Texas, Dallas, Texas, Denver, Fort Lauderdale, Fort Worth, Jacksonville, Las Vegas. These are all in the negative month over month category, despite the overall national pop. Okay. You see Chicago's down to just 0.05%. So basically flat, while their year over year is at 13.7%. That's a huge year over year in Chicago. Milwaukee's down to a 0.59% month over month, while their year over year sits at 13.24%. Los Angeles went down month over month. Also, Nassau County, New York went down. Minneapolis went down. These are month over month declines. You don't see any declines on the year over year. Oakland down month over month. Orlando down month over month. So 20 of the 50 metros here covered by Redfin down. Okay. That's 40% of the 50 most populous U.S. metro recorded the seasonal adjusted drop in home prices in August. We're talking about this a lot. I'm going to continue to talk about it, because if you have a client who's thinking about buying a home and they're just deciding between now and later or after the holiday, whatever, I mean, these are the opportunities. This is what I expect. These seasonal declines, I expect next month it to be 30 out of the 50, or maybe even 40 out of the 50, to be a slight decline. This is when you can get a property where you're going to get a little bit off the price tag than you're going to in the spring, that you can get a seller to maybe negotiate because they have more motivation this time of year. Okay. This is where the opportunities live for buyers. The biggest decline though was in San Antonio at 2.4%, followed by Warren, Michigan at 0.9% month over month drops. Oakland was 0.7%, mentioned them earlier. The highest month over month gains was Philly at 1.5, Detroit at 1.3, and Providence, Rhode Island at 1.2. So there's your Redfin look at August pricing as we sit here today. The 10-year hit another 52-week low today. So FOMC meeting kicking off. JPOW, boys and girls, fresh off their Jackson Hole trip, having their meeting, and the 10-year hits another 52-week low today. We've seen this a whole bunch over the last couple of weeks. I think I've seen a 52-week low 3 times over the last, call it 2 weeks. Coming in right now in real time at 3.646. 30-year fix yesterday came in on the final read at 6.12 for the day. So we've been living in 4 consistent reads now from September 11 through today, in that 611 to 615 range. So low sixes. Really hearing a lot across the country. Agents saying having clients getting locked in with their lender in the high 5s, the 5.9s. 5.99 seems to be a go-to rate right now for lenders. A little Walmart pricing for the lenders, but it feels good when you have a 5 in front of it. 6.2 on the weekly. Again, as we mentioned yesterday, Also, CME Group is moving even closer towards predicting a 0.5 point cut. Now, 67% is the expectation that it'll be a 0.5 point tomorrow when Jerome Powell does his press conference in the afternoon. 67%, according from CME Group, it's going to be a 0.5 point. 33% that it's going to be a 1/4 point. There's zero expectations and just literally zero chance that there is no cut. All right. There is a cut coming tomorrow. Just as the Zelman and Associates member, Alan Ratner, said, it's just a matter of 1/4 point or 0.5 point. CME Group now leaning towards 0.5 point tomorrow, although a lot of that is already baked into the 30-year fixed, according to many of the experts right now. All right, there's your hot sheet here for the today. Later on the channel, we will have a brand new Real Word pod. So stay tuned for that. I'll see you guys over there later on today. And also, if you're interested, tomorrow at 2 p.m. Eastern, we have a BAM webinar with Luke Cree from Reminder Media, as well as The Broke Agent, hosting a absolutely free BAM webinar tomorrow, 2 p.m. Eastern time. So I think Haley will put the link down below. Haley is putting the link down below. There it is. BAM webinar with Luke Cree and The Broke Agent tomorrow, September 18th at 2 p.m. Sign up for that completely free webinar tomorrow with Luke and The Broke Agent. Luke will be actually, from Reminder, at BAM Mania. He'll be with us during the VIP experience. And obviously, Reminder Mania is going to have a presence throughout the event. Make sure you grab your tickets to BAM Mania at bammania.com. All right, there you go. Hope you guys have a great Tuesday. Again, see you over at the Real Word Pod, and I'll see you back here tomorrow as well. Until then, toodaloo.